You're about to join Niels Kaastrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Richard Brennan and I, Niels Kaastrup-Larsen, where each week we take the pulse of the global markets through the lens of a rules-based investor. If you're new to the show, I hope that today's episode will trigger your curiosity enough to check out the back catalog and listen to the past episodes that you may have missed. Like my conversation with Alan last week, where we discussed what causes trends and how trend following may handle a soft, hard, or even no landing, and why we may still be at the beginning of a commodity super cycle. I would also encourage you to listen to the midweek episode where Harry spoke to Michael Gayed about his approach to the markets based on indicators like the lumber to gold ratio. But it also turned out to be a very raw account of what has been like for him going through 2022, which he describes as hell. And I'm sure he's not the only investor who feels this way. And if I can plug next week's episode on Wednesday with Annie Duke, this is an amazing episode, particularly if you like systematic investing strategies, as there are so many lessons from her new book, Quit, that we can use in our world. So head over and check out these episodes when you have done listening to Rich and I today. Anyway, Rich, great to be back with you as always. How are you doing? How are things down under?
Really good, Niels. It is slowly getting warmer here, but we've had a sort of extended winter. But it's starting to pick up over here, so it's getting more and more humid as time progresses. But all good. Keeping my eyes out on what's happening over in Ukraine. I'm a bit nervous about what Russia's plans are. So it's still an uncertain environment, and the trends are doing very well at the moment.
Yeah, definitely, and we'll get back to that in a second. Now, in terms of a market wrap for this week, there's no doubt that the headline is higher rates for longer. That was the concise message out of the Federal Reserve this week. After an attempt at rallying on Monday, both stocks and bond prices rose with quarterly rebalancing and short covering. Markets again were overwhelmed by the Fed's message by the end of this week. Now, the week started out pretty strong for the S&P 500, up about 5.5% at the end of Tuesday. And the yield to maturity on the 2-year Treasury notes finished at a low point around 17 basis points lower at 4.09 in terms of interest rate. Now, these rallies were mainly driven in part by the third attempt, essentially, at the narrative that hopes that the U.S. Central Bank is on the cusp of slowing the pace of rate hikes, even now with the UN weighing in this week to put pressure on Powell and company. But maybe not so fast, as all the Fed members are on the same page and advertise the same resolute message, namely higher rates and higher rates for longer to squash inflation. By close of business Friday, the S&P was still positive for the week, although Friday's ferocious sell-off erased about 3%, and the 2-year note was back to its quarter-end high of 4.3%. Now, the catalyst was many, but U.S. non-farm payroll data released on Friday morning will get the most attention for sure. Payroll employment figures came in slightly above expectations, and the labor force contracted a touch. The result was that the unemployment rate was 3.5% for the month, an improvement from 3.7% reported in August. And although employment gains have slowed from the blistering pace of 2021 and early 2022, a number of 263,000 payroll is still way above trend growth. So we conclude that despite the tightening of financial conditions since the beginning of 2022, employment remains firm. Now, for bond investors, this year has been the worst drawdown so far in a broad fixed income market on record. And at the end of September, the aggregate index now is down 15%. Now, perhaps there is more to come of that because the Reserve Bank credit dipped by a healthy $45 billion from 7 days ago, leaving the Fed's holding of interest-bearing assets at $8.73 trillion. Now, that's down $190 billion since late March, where it peaked. So $45 billion in a week is not bad. All eyes next week will be focused on inflation and retail sales data, as well as the first of the third quarter earnings that are being released. So the question is, of course, has the financial tightening been enough, or will the Fed need to use both feet on the brakes? Only time will tell. Anyway, Rich, since you were last on, what's sort of been your focus, either in terms of market moves, maybe in terms of some of the performance that we've seen coming through the grapevine, and of course the battleship? I hope it's cruising along well.
It certainly is. So, so September was a great month for the battleship. We managed to post some very good gains in that month, notably because my portfolio is focused more towards currencies and has less exposure in bonds. The things that were standouts for me was this continuing trend in the yen pairs, such as the USD Japanese yen and the Swiss yen pairs. The Euro USD, of course, got a nice kick with the collapse in the pound with my currencies. So, it's a magnificent time. At the commencement of this month, which we've only had about 8 or so days of, I did get a bit of volatility there, but fortunately, because of my loose pants models, they weren't thrown out of the trends, and we've found that they've reverted back into those trends that have been, pre-existing for quite a few years now for many of them. So everything is still going along as per normal, and I just notice how a lot of the trend following programs are posting some of their record periods year to date, I think historically. I've got a number of large trend following funds posting magnificent returns for this calendar year, which is really an extension of the last 2 to 3 years. We've had this magnificent trending regime, and it's particularly pronounced this year. I don't know how long this is going to, none of us know how long this is going to continue, but we certainly make hay while the sun shines, as they say.
It's kind of interesting, isn't it? Because, there's obviously been a lot of talk about whether these simple strategies still work, or have market structure changed? Are markets moving more quickly now because information is disseminated so quickly and everyone has access to it, and so on and so forth. So in that sense, I actually find it quite interesting to see that we are witnessing perhaps the strongest trend following year, maybe even on record, but certainly among the top 3, I would say, probably throughout trend following history, more or less. Top 5, top 3, doesn't really matter, but certainly up there. So what does that tell you? In a sense, if you think about the fact that, okay, from the 70s to the 80s to the 90s, so much has changed in the past 20 years. It is so different, really, compared to back then. Yet, performance is obviously as good as, or maybe even better than what we saw back then. What does that tell you?
Well, it's very interesting to me, because I noticed that those trend following programs with a very long-term track record, they haven't necessarily adjusted their strategies significantly over that 30-year period. But now we are witnessing this explosive growth. So it's telling me that, it's almost saying to me, place less sort of importance on the backtest or what history is presented. Provided your models provide this upside and you cut losses short, you will enter regimes we've never seen before, which can certainly, produce a bonanza in these days. You've got to praise these trend-following programs that have had the persistence and the patience over 25, 30 years of not tampering with their models. And you see the benefit of this, maybe 30 years down the track of not tampering with their models, where they suddenly achieve the best returns they've ever achieved in historical terms. So it's very impressive to me, and it just shows how robust the method is, how despite the desire to want to change things, you might think that markets are changing. I think there are these golden rules that you need to stick with and be very patient with over the very long-term period. And it's the market that delivers your bounty. It's not your finesse in changing your system rules or the intricacies of system development. It's more the patience and persistence to wait until the market decides when to deliver its bounty.
The other thing that I think is interesting, because as you mentioned, there are many firms doing really well this year, but we're not the same. We're all a little bit different. We trade different number of markets. We trade different markets. Some people don't change the position size. Some people do change the position size. All of the things we've talked about on the podcast that makes us different. Yet, as we can see, it is a pretty broad-based rally, let's call it that, in terms of performance of these strategies. And to me, that goes to this term that you mentioned there and that we've talked about a lot, but it is kind of elusive a little bit, and that is this robustness, meaning that we can, as long as we stick to the golden sort of rules of trend following, whether we do it a little bit this way or whether we do it a little bit that way, it doesn't actually spoil the strategy and its ability to continue to adapt and really more importantly, in my view, to continue to navigate an environment that it has not seen before. I think that's the critical part. Because I do believe that a lot of strategies kind of rely on things repeating themselves. But in our case, it's really not the case, so to speak. It's really about completely new, just like we saw oil go negative, never seen that before. But no CTAs blew up because of that. And all of these completely crazy things we've seen in the markets, yet we're all still here for the most part and doing well. And as you rightly said, many of these firms and strategies have been around for 30, 40, even 50 years. I think that is impressive, and I've never quite understood why that is not being appreciated more by the people looking from the outside in.
Mm, no, definitely. And yeah, it's always surprising to me that, I believe that trend followers take opportunity under uncertainty. And, this is unlike other methods that are relying on predictive stability. I think our methods blossom under uncertainty, and it's exactly because we haven't seen these environments before, and our models tend to capitalize on these opportunities. So if we imagine this market is a zero-sum game, those traders that are working on the premise that history repeats, or the patterns repeat, when their models break down, I think this is where there's a mass shift in transference of wealth to those models that capitalize on the opposite side of the spectrum, which is capitalize on uncertainty as opposed to predictability. So, as we go through these different regimes, I think there are certain models that do well under predictive certainty, and then there are certain models that do well under uncertainty.
And of course, that is true. I mean, it is true that trend following has done well during uncertain times, but I always want to stress is that we don't need uncertainty per se. I mean, we've done perfectly well during times where things were more stable. And I mean stable in the sense not the prices don't move, but stable in the sense that we don't have a war in our backyard, or we don't have, inflation at 10% and all of that stuff. And this is what still fascinates me even after all these decades of doing it. It fascinates me that you can have a strategy that actually is able to handle probably both environments pretty well. But of course, we know that the transition period is always going to be somewhat painful because markets change direction, and therefore we have to adapt our positions accordingly. Anyway, I'm sure we'll come back to it, but it's just still... yeah, it's fascinating. Anyways, this week, I think that most trend followers had a pretty soft start to Q4. There were some short-lived corrections in the markets. And as I mentioned earlier, this was driven to some extent by the UN suddenly weighing in on what the Federal Reserve should do with its monetary policy, which strikes me as being somewhat out of order, that an organization like that should kind of put pressure on a central bank and question their independence to that extent. Having said that, after a couple of days, the focus shifted to some extent because we started looking at some of the challenges that we are still facing, not least the high energy prices. And that came in the wake of the OPEC Plus making this very blunt statement saying that energy security comes at a cost. And this was in the wake of them announcing that they're going to cut 2 million barrels per day of production, which is, it's a very interesting time to do this on. And I'm sure there'll be plenty to talk about going forward with that. But it could actually, from a trend following point of view, put a little bit of a floor on the energy prices, which have been under pressure for the last 4 months, maybe 5 months, since early March, really, when they peaked. So this will be quite interesting to follow. You and I were talking off air before we pressed record a little bit about energies is an interesting sector right now because are trend followers short? Are they long? Are they kind of neutral? Hard to tell, depending on what kind of methodology and time frame they're applying, of course. But if you are longer term, I think you would probably still be long, and then this week would have been very productive from a performance point of view in the energy markets. Fixed income, of course, our friend that keeps paying dividends, so to speak, did well this week, I imagine. Currencies, maybe even grains, contributed positively. Not so sure about metals, soft and equities. Again, a little bit depending on time frame and look back and all of that. My own trend barometer finished the week at 48, so it's, a little bit towards the higher end of neutral. So could go either way. Performance for the week so far and for the month so far and for the quarter so far, for the indices we follow, this is as of Thursday. Friday was definitely a positive day for trend followers, but not sure it makes it all the way to a positive territory. But the Beta 50 index was down 46 basis points as of Thursday, up 18.88 for the year. SocGen trend, the CTA index, down 73 basis points, up 25.19. SocGen trend index down 1.46% for the month, up 33.6 for the year. And the SocGen short-term traders index down 53 basis points, up 12.4 for the year. Comparing that with the MSCI World, which actually did finish the week positive, up 1.64%, but down 25.19 for the year. And the World Government Bond Index, another losing months again, down 49 basis points so far in October. We have one question, which is not going to take that long to answer. So let's do that first. And then we have some quite interesting topics about trend following, funnily enough, that we want to dive into, but maybe from a slightly different perspective than what we normally talk about. So let me just read the question, and then you can give your view, Rich. So this is from Josh. Josh writes in, question for you and your guest. When opening a trend following position, and here I'm talking about equity and long and fractional in my small retail Robinhood account, and I calculate a 14 or 15-day average true range based on as a stop loss, say 2 ATRs. Do you enter the stop and have it fire intraday, or do you keep the stop loss price as a mental price and take it based on the close, or do you just watch it all day?
Yeah. So good question from Josh. Look, the first thing I'd just like to say is that when we're talking about trend following and we're talking about the returns delivered by trend following, we talk about these significant outliers that we target. Now, because of the magnitude of these outliers, it means that the materiality of things like entry and the things like when we stop out of our position really is quite immaterial over the long term with our statistics. So the benefit of trading sort of the medium to long-term timeframes is that the impact of trading costs associated with the finesse of how we enter, how we exit, etc., is far less material than if we were trading more aggressive strategies that were, say, trading intraday, where suddenly things such as trading costs, when we enter, all of these things become exceedingly important because the costs of those trading decisions are material to your P&L. But in relation to the materiality to my P&L, the questions that Josh proposes are quite immaterial, really. But the way I do it is that I use algorithms that base their calculations 30 minutes after the open of a market. So I'm not actually doing my calculations on the open or at the close of the market. I'm waiting 30 minutes. I do this for all of my systems just to wait until the frenetic activity of the open starts dissipating a bit, and then my algorithms execute 30 minutes after the open. And at that point in time, they do a calculation. And if that calculation says enter the trade, I adopt a market order and go straight into that trade. I don't adopt stop orders or I don't adopt limit orders. One of the reasons I do that is I don't like brokers knowing where my order entries are. So I adopt a market entry position, which does occasionally give me a bit of slippage. But as I said before, the materiality of that is insignificant over the long term because of the nature of the outliers that I'm targeting through my method. So, it's on the open, 30 minutes after the open, a market order for entry. And my trailing stops, however, they do operate at all times during the day. And once that trail is hit, I'm out of that position. And I just do that as a matter of principle because a lot can happen in the course of a day. So I like to execute my exit as soon as that price is touched on my trailing stop, rather than, for instance, wait until the end of the day or the open of the next day to exit my position.
Yeah, no, I agree with that. You might as well leave the stop sitting in the market. That seems logical. I've even actually heard about managers who execute their signals a couple of days after they are generated because, as you rightly say, it's not so much. Long-term trend following is not that sensitive to that. I'm a little bit surprised to hear that you need, and maybe I misunderstood it, that you need a little bit of data to run certain algorithms at the open, because for a long-term system, you would think that 1 day's worth of data or half an hour's worth of data doesn't really matter.
Now, what happens in my world with the markets that open, according to my brokers, they don't open all at the same time. They open in tranches. So over the course of a half-hour period, different markets are opening consecutively. So that's why I wait until 30 minutes after the open, effectively, because they sort of have a tranche opening as opposed to all open at the same time.
So another question that just comes to mind when we talk about this, and that is, I'm not sure you and I have talked about it. I know I've talked about it with some of the other guys, and that is, do you think that the exit may be more important than the entry? And what I mean by that is, of course, the entry is important because we need to get in. So this is not the question. What I mean by it is that whether you apply moving average, crossover, breakout, time series momentum, whatever it might be, I would be so bold to say that I think the entry points are not going to be vastly different. Of course, they're going to be different if you're super short term to long term and all of that. But generally speaking, I think we can almost see a trend emerging or when it starts just by looking at a chart. I mean, you can almost see it with your eyes. So I've always had this slight feeling that we all get in more or less at the same time, let's say within the same week, for example. But where we get out kind of can be more defining for how much of the profit, if it's a profitable trade, we can capture. And also, I think that there are many more exit methodologies or rules that people apply. And and therefore they are probably somewhat more different in terms of where they are in the markets. Is that something you have thought about? Or
I hear a lot of people say the entry is not important, but in my
no,
world...
I didn't. No.
Yep.
I didn't say that. I didn't say that it's not important.
Yep.
What I'm just saying is that I think that we as an industry are more likely to be getting in more or less at the same
time,
in the same area, not the same time necessarily, more or less in the same area. But I'm not so sure I could say the same about where we get out. That's all.
Yeah. Well, for me, entry is important to me because, for instance, if I randomly entered the market at any point in time, irrespective of when trends had materialised, if I did that, then clearly I'd have a hell of a lot of whipsaws and, be unprofitable. So clearly I'm waiting for some price event to occur before I even consider participating in that event. So to me, the more I delay that entry event, the more material the price move has become before I enter that trend. Now, what that does to me is that, therefore, it pushes my entries out towards the tails of the distribution. And I think that's a good thing for me because I like to think that the particular area of that market distribution I'm targeting are the left and right tails. Now, no one knows where they begin or end, but we do know that as we sort of wait to enter trends that become more and more material in nature, you do increase the probability that you are entering an outlier by restricting your trade entry to avoid what I call the noise and mean reversion that tends to be associated with a lot of trending environments. So once you do wait for this extreme entry, I think this does reduce the probability landscape to have a greater chance of capturing outliers in your distribution of trade returns. So to me, that's why entry is important to me. But as you say, exit is very important because exit, the method of exit ultimately determines the level of P&L you obtain. So how profitable you are. I'm a big believer in trailing my stop. I probably have less loose pants than some other trend followers in relation to how I do my trailing technique. But, clearly I don't set profit targets. So a profit target to me is not a correct way to validly trade a trend because if you set a profit target, that means that you have some idea or understanding of where that trend is going to end. Now, because we're targeting these outliers, which are anomalies by definition, unpredictable in nature, we need to let them run their course because no one knows how long they're going to go for. So a trailing method is the ideal technique to capitalize on this propensity for some trends to become extreme in magnitude, which means that you don't lose all of your profit off the table by waiting for it to come back to your original your stop loss. Your trailing stop is continually sort of progressively with beneficial price moves is ratcheting up behind your price. But it means that you do give maximum freedom for those trends to be of significant magnitude, but you do ultimately have to take that profit once that trailing stop's hit.
Yeah, no, I like that. I mean, I think that makes sense that you can, to some extent, if you're really targeting outliers, you can tilt your entry rules as well to increase the probability of that. I think that is fair because, as we've talked about before, you would rather make more money from the 5% or 10% of trades, maybe compared to someone who say, well, I may not make as much money on those, but I'm going to make more money on the 50% other profitable or 40% other profitable trades I'm going to have. So I think that's fair. All right, Rich, we're going to dive into some trend identification and certain things we have to avoid and so on and so forth. So it's going to be another masterclass, I have a feeling. So let's dive into all of this and I'll do my best to keep up with you.
No, well, thanks, Niels. But look, we're going back to the basics here. So, What we're doing is we're talking about trends, and we're talking about visual methods of identifying trends versus systematic rules-based methods of identifying trends. We're comparing and contrasting the different methods. So, when most people begin their trend following journey, they tend to be drawn to the idea that we need to be prescriptive in the way we classify trends. So, you might go back to Dow theory, which says that for a valid trend, you need 3 consecutive highs and 3 consecutive lows, etc. Or there might be other definitions of trend where they're using moving averages to define what the trend is. But there is this plethora of different ways of identifying trends. But the problem with that plethora of methods of identifying trends is that no one has a common understanding of what the trend is. They all have a personal interpretation of what they view a trend is, dependent on the interpretation they're using to identify what that trend is. So this is different to, for instance, the diversified systematic trend followers who use more quantitative methods for trend identification. So they're using the data as a basis to give them clues as to whether there is a trending environment or not, as opposed to the visual form of a trend. So one of the problems we face is that if for instance, I went to my technical analysis class where I looked at identifying trends, and we put up on the blackboard all of these different trend configurations, everyone will be saying, well, look, that's a trend, that's a trend, no, that's a trend, no, that's one of the trend, that's a trend, etc. There is just no consistency. But having a systematic rules-based approach means that everyone will agree if we use the same systematic rules-based approach, everyone will agree on that interpretation of a trend. It differs, of course, when you're applying discretionary judgment and using visual clues and the way your brain works to identify what is a trending condition. And we often find when we revisit something that previously we disregarded as a visual trend, when we come back to it, we say to ourselves, oh, how did I disregard that as a trend? Clearly that is a trend now. So your brain and its pattern recognition changes over time as well. So there is no stationarity to how your brain perceives trends. It's a moving feast of emerging patterns that change over the course of time. So that is why in one of the problems, if you are very prescriptive in determining what is a trend, you will find that you potentially miss out on a vast array of different visual forms that also are trends, and you will find that you potentially miss the outlier because you are demanding some prescriptive form of visual trend before you entertain the prospects of trading that trend. So what we say in our quantitative world is it's better to be less prescriptive in how we define a trend and simply recognise a trend as a over the course of time, a directionally extended series of price data, as opposed to getting in all of the nitty-gritty about the exact visual form that trend should take. So what we find, if we do get prescriptive in how we define a trend, we can have these what we call type 2 errors. And for a trend follower, a type 2 error is perhaps the biggest sin. So we, of course, have lots of small losses, but they are only small losses to us. But a type 2 error is where you miss the outlier. And because those outliers are such large contributions to our P&L, if you miss one of them, that can be quite drastic for our fortunes over the long term. So we avoid this prescriptive tendency to classify trends according to what specific visual form it has, and we use quantitative methods to basically give a degree of loose pants in our definition of how we describe a trend. So the looser we define that trend, the better the chance we have of capturing a vast array of different possible forms of trend, as opposed to being prescriptive. What do you think about that?
Yeah, no. But first of all, by the way, so you talk about a type 2 error. Well, what's the type 1 error in your book?
Now you've got me. I'd have to go back to my book. But I think
okay, no, that's fair. That's fair. No, I didn't mean to try. It's just that I hear these terms being talked about a lot, and I'm not always sure what people mean by it, but that's fine. It doesn't really matter.
I think a type 1 error is a mistake caused by some programmatic error. A type 2 error is more like an opportunity cost, missing out on something, I think. But I'd have to check.
Anyways, I'm going to try and visualize what you just described. We'll talk about this, I'm sure, a little bit more. But one thing I noticed in our own data is that the best performing market for us in the last 5 years is a market that did not make any money for quite a while. And I'm actually talking about short-term interest rates. Okay, so here we have a group of markets that, if you looked at the price from say 2000 and this is just ballpark, say 2018 through 2022, it's like a flat straight line because they were all pegged at zero. So there's nothing going on. But you could still, because of roll yields and so on and so forth, you could still get a signal. But then earlier this year or towards the end of last year, I can't remember exactly when, you started getting this little breakout, which looked like nothing. And given the fact you've had like a 4-year period of flatlining, you think, this must be a mistake, right? You're not going to fall for that. It's like the JGB trade, like the widow trade, where every time you try to short it, you're going to be stopped out, right? So, but it just goes to show that a market that essentially had given you no opportunities for quite a while suddenly can give you amazing opportunities. And as you rightly say, it didn't look like anything like what a normal trend would look like visually, because it was just a flat line and then a little blip, and then suddenly it became a real trend. So that was what I was thinking about when you were talking about different types of trends. I mean, because I think our gut reaction when we think about trends is some kind of, here's a range of a market, it's consolidating, then it breaks out, and then it takes off. It's kind of, okay, that's a trend. But there are these weird other situations where it just looks completely different.
Yeah, exactly. And, one of the problems we're facing is that if we're using our brains to interpret what trends are, so I'm fascinated with some of these recent research findings by some of the cognitive neuroscientists like Anil Seth and Donald Hoffman. They're very interesting, and so what they're proposing is that our brains are effectively these prediction engines. So if we could imagine the brain itself is encased in a skull. So it's reliant on all of the sensory data being received by our senses, so through our eyes, through our taste, through our nose, through our touch, etc. These are just sensory impulses. And when I love sometimes thinking to myself, well, what happens if we don't have any ears? So for a person who has no ears, there is no sound. And that's because what we are really picking up with what we refer to as sound, which we believe is out there in the environment, is just these, pressure points of molecules vibrating. That's effectively what it is. So it's the human ear that is interpreting this as sound. But ask another creature that might not have an ear how they are interpreting that same sensory input, and they might come up with a totally different conclusion. And so, it's very vivid when I think of the sound. If I don't have ears, I don't hear any sound. And if, this is something that is familiar on this planet Earth. But if we go out into space, there is no sound out in space because there is no, molecules to vibrate in this, in the spatial arena outside of our planet Earth. So in space, no one hears you scream. So these are concepts that we are so familiar with, these concepts of sound, sight, smell, etc. But really they are our methods of interpreting our external environment. And that external environment may be significantly different. The reality of that external environment may be completely different to how we are interpreting it, because effectively, as a species, as a human species, we have evolved these senses to give us a survival edge. It's given us a competitive advantage. So we hear sound because it's given us a competitive advantage. There might not actually be this concept called sound out there, but how our bodies over time have evolved and how we have adapted the sensory inputs into how we interpret it has given us a survival advantage. So people like Anil Seth and Donald Hoffman are now recognising that the world in our external environment may be completely different to what we perceive as human beings and with a brain. And one thing we are certain about is a brain's ability to predict. And so Anil Seth refers to our perception of experience around us in our environment as a controlled hallucination. In other words, he calls it a controlled hallucination because at least everybody agrees on that same hallucination. So this is different to the hallucination you might receive under the, a certain drug intakes or whatever. So everyone's receiving this same controlled hallucination simply because we've all evolved and we have the same ears or similar ears, the similar design features. So we're interpreting things in a similar way, but it could be considerably different. So it's given us a competitive advantage in this natural environment. But as traders trying to trade this market, the markets, the financial market, is something we haven't evolved in. So what the brain is doing might be contra or different to the way we should be interpreting these financial markets. We haven't evolved in those financial markets. We don't have sensory apparatus that is honed in on what the financial markets are doing. So the brain is a pretty bad guide to how to trade that financial markets, which is why I always prefer a systematic rules-based approach as opposed to letting my brain override my rules-based approach, simply because that brain has evolved in a different context to the financial markets which I'm trying to trade. So does that make sense?
Yeah, so do you think that if we're going to stay with your analogy here, do you think the fact that we only, or for those of us who only really need an open high-low close on a daily basis in terms of price, is that kind of the same as not having any ears, meaning we don't hear the noise intraday? We just, oh yeah, it was this high, this low, this is where it opened, this is where it closed. That's all I need to know. I don't need all the noise that took place.
Yeah, it sort of gets worse than that, though, because a chart, a chart pattern is a visual representation. It's not actually the way the market operates. So when we see how the market operates with the orders coming in and the matching of orders and then the transactions taking place, that is a different representation to what we visually see on a chart. We like to simplify things on a visual chart and say there was a open, there was a high, there was a low, there was a close. But that's not actually the way the market really operates. It's just our visual representation of that. And you can use different visual charts as opposed to the open, high, low, close chart, different visual charts to represent different interpretations of those transactions that are occurring in the financial markets. So those people that are hell-bent on using charts as the definitive guide to identify a trend, they're really restricting their abilities to a degree, because it's not necessarily the way the market actually works. So I think quantitative methods. So in other words, one of the key reasons we use these extensive back tests is because we want to reduce the ability of our brains to override our decisions and ensure that we've got a systematic rules-based process that has that everybody can agree on because we use the same system rules. So if I pass my system rules on to you, Niels, you will get exactly the same definition of trend as I'm getting because we're using the same rules-based process. Those rules-based process also have been forged over very large data samples. So it's reduced the fickle nature of our minds to, one moment we might see a trend and when we revisit it at a later stage, we'll say that was never a trend. This sort of eliminates that discretionary override and the way our brains work to a much more systematic rules-based process that is more definitive, can be agreed on by everybody, and is a much more rigorous, I think, way of validating empirically the nature of a trend or a bias price series.
So before we move on to the next point, I did find my note for when we recorded with Annie Duke, and there was this one quote that I wanted to share with you, even though it's going to come out in a few days. So this is a little sneak preview, Rich, but I think you're going to like it. And Annie says at some point, she says, the more you can systematize the decision, the better off you will be, which of course is something that just plays so well into our world. And of course, she comes at this as a incredibly successful poker player, but now someone who coaches people, I think, about making decisions during uncertain times, which I think many investors and certainly trend followers, that's exactly what we've been dealing with for many decades. So
it's very exciting. I can't wait for that podcast, Neil. So I spent a lot of my youth in the casinos, so I do love looking into the details of the different games of chance and looking where the edge resides, and if there is an edge present or if there is simply a house edge present, etc. I think these things I learned at the casino were quite foundational for my move into trend following. It's something, one of the reasons I moved into trend following was that clearly I saw this definitive edge in trend following, particularly in the nature of markets to be non-normal in nature and have these tail properties. And, when I started seeing these tail properties of markets, every liquid market I assessed, I saw these tail features of these liquid markets. I thought, there's my opportunity that lies outside the normal distribution. This is something I can capitalize on. And thanks to, the seedy days of the casino, I think, it's taught me a lot about how to identify where an edge exists.
Yeah, no, absolutely. And by the way, she's also a wonderful storyteller. She has some amazing stories that she shares, which actually helps explain. We know how important narrative is, right? But it actually it's given me a couple of new ways to talk about things like stop losses and stuff like that. But I'm not going to steal her thunder, so let's wait until at least next week. So anyways, where are we going to go next with this trend thing?
Okay, so we've talked about the trends in the market data, but there are two things that define trends as far as my understanding. And firstly, there needs to be a trend in the price data, which is this directional series of events. But not only does there need to be a trend in the market price data, but also our ability to capture trends is dependent on our system configuration. In other words, what I mean is that to be able to extract that edge from the market data, we need to have systems that are capable of extracting that edge. So, the way we do this is through these very simple designs that limit the degree of price freedom that is allowed when we enter a trade. So when we enter a trade, we configure the initial stop where it needs to be located. We configure the trailing stop, and effectively they are like system constraints. They're like, if you can consider a system like a container. It limits the adverse price excursion that price is allowed to go before you exit that trade. So that therefore minimises our adverse risk exposure, but we don't set any profit target. We are unbridled with our directional extent, the future potential of that directional extent. So we use this trailing stop mechanism. And if you can imagine, yes, we do mitigate all adverse risk exposure with our small bet size, our trailing stop and our initial stop, but we allow for this unlimited possibility in relation to how we want price to move. So our ability to capture these trends is both a component of the trends that exist in the market data and our system configuration. So what this means is that, as we said before, because there are these many different various forms of visual trend, we need a very loose pants definition of how we capture that trending price series to give maximum degrees of freedom for price to play out, because there is a large component of random gyrations in any price series, but there is a much smaller component of bias in that price series that ultimately manifests in this momentum that exists in that trending price series to enable us to capture this trending price series. So effectively, I just want to make it aware that when we do talk about trends, it is so. People say, well, I looked at trends in 2012 and 2014 where people were declaring that trend opportunities don't exist. And when I looked at the monthly price data of all of these liquid markets in those periods of time where people say trend following no longer works, I thought to myself, well, why is that? Well, visually, I can see these trends existing, but why aren't trend followers capitalising on those trends? And what we find is that with these adaptive markets, over the course of times, trends do change in form and they change in their degree of volatility. And that means that over the course of time, we do need to adapt our systems to take into account this growing variability of trend form. So, whilst we might have developed trend following systems back in the 1970s, the variables associated with those simply designed trend following systems might have changed over the past. But, the trends I saw in 2012-14, they were valid trends, but they were very difficult to trade. And this reason was not because trends in the market data didn't exist, they did, but our system's ability to capture that trends was more difficult because these trends were much less defined, much more volatile. They had a greater variety of different forms than what we'd trained those trend following systems on in the past. So there does need to be this degree of adaptability in our trend following models to continuously refresh in light of new data we receive, new trend form information that we receive. We do need to continually include this progressive additional data so that we can retain this very loose pants system design. Another, as we've talked about quite regularly over our podcast series, the more prescriptive your design elements are, the more, so in other words, the more parameters and variables that you have in your system design, the more the system constraints restrict the degrees of freedom of price. So what that means is that the more variables that you adapt, you are more prescriptively defining how that trend needs to perform in the future based on a backtest series. So, for instance, if I decided to have tight pants, I could develop trend following systems that mirrored how they'd behaved in the past exactly, but that would restrict my degrees of freedom in relation to new opportunities, new emerging trends that we hadn't seen before. I wouldn't be able to necessarily capture those trends if I overly restrict my designs to suit what has occurred in the past. So I need this freedom to allow trends to adapt, to change in nature, to have these loose pants.
Okay, so let me ask you a question. We look at essentially how different look-back periods would have performed every calendar year, going back in time, to give us an idea of whether, 40-day look back or 240-day look back, what seems to be better? Let's use that word. Now, when you look at the evidence, meaning if you look at the data, there's a clear gravitation that the better look back periods are not the shorter ones. So my question to you here is, do you think actually from what you just said that this is the reason why shorter term look back periods are just not profitable to the same degree as longer term, simply for what you just said, namely that we need, in lack of a better word, looser pants. We need to allow room for many different types of trends. And if you, even with that single parameter as look back period, if you restrict it too much, it just doesn't work as well. Is it both that complicated but also that simple?
Yeah, look, I have looked into this quite extensively, and how I do that is I research how short-term models that are configured exactly the same way, apart from the look-back, compare to my medium to long-term models. Now, what I find is that all three, let's say I have short-term models, medium-term models, and long-term models. They're using a similar ATR in their initial stop, a similar ATR in their trailing stop, and a similar multipliers. But the things that do change is simply the look-back. So what I find is that the short-term models, the medium-term models, and the long-term models, yes, they all capture outliers. There's no question about that. But what the short-term models do, more than the medium-term models and the long-term models, is they also catch a lot more noise and mean reversion than, even though they capture these outliers, they're capturing a lot more noise and mean reversion that compromise the P&L. So when I look at the, let's say I have a short-term model, and let's say that short-term model generates 1,000 trades over a 30-year period. Then I've got a medium-term model. The only thing I've changed is my look-back and my long-term model. The medium-term model might only have 300 trades. The long-term model might only have 100 trades, simply because of the change in the look-back. But what I find is that all three have a representative inclusion of outliers in their distribution, their trade distribution. But what is much less prevalent in the medium and long-term models is this degree of noise and mean reversion, these linear sort of inconsequential wins or losses. So what I'm finding is there is more frictional drag in my short-term models that compromise my results. So what this tells me is that we always talk about how we're targeting these outliers and these significant anomalies, these that always are far larger than what we can predict in, according to a normal distribution. But what I think we find is that as we step out to these medium to long-term models, what we're inevitably doing is we're playing more in the tail region of the distribution than we are in the bulk of the distribution. So when we play with our models in the bulk of the distribution, we're capturing a lot more convergence and noise than what we do when we step out to the tail regions. And I think the longer term lookbacks naturally migrate us further out to those tail regions.
Yeah, no, I mean, I think that makes sense. Anything else in terms of the points you wanted to bring up today?
Let's have a look. So, okay, what I'd like to do is quite a contentious thing here and suggest that in reality, nearly all traders or investors are actually trend followers. Now, what I mean by this is that apart from some restricted strategies like options selling, nearly everybody as a trader wants a different entry price to their exit price. They're looking at a difference in originating price and exit price to generate their profit or potentially their loss. So they're looking for a trending price series between their entry and their exit. So, in broadest possible terms, everyone, the gambler, the convergent trader and the divergent trader are all effectively trend followers, because you know how I said we all tend to interpret trends differently? Well, a segment of a mean reverting cycle, which goes out from a maximum favourable excursion back to an equilibrium, has a trending component. And, if you look at that at the small scale, it looks like a classic trend. And a lot of people that trade counter trend are trading those mean reverting components of a bigger mean reverting cycle. The divergent trader is also capitalizing on trends. So what sets apart the divergent trader from the convergent trader and the gambler if they're all trading trends? Well, what we are looking as divergent traders is this enduring directional persistence in that trend. So we've talked about visual trends and how difficult it is to do it. But really, the reality is that they're more academic topics, because when we are trading on that right-hand side of the chart and making our entry, we don't know what price is going to do in the future. So we're staring into a black void. We know what's occurred in the recent past because we've got this trending price series. So our systematic rules has identified, well, there is a trend that has occurred, but now at my point of entry, I'm now staring into the black abyss. So what a divergent trend follower is relying on is some form of enduring persistence in that directional move at the time of entry that continues on in the same direction or a similar direction in the future. Now, that is referred to, that enduring persistence, or what we often refer to as momentum, is what we refer to as serial correlation. And in this particular example of a divergent trend trader, we are looking for positive serial correlation. Now, this difference to negative serial correlation, negative serial correlation is something that a convergent trader or a mean reverting trader is looking for. Now, what that means is that a negative serial correlation means that a high is followed by a low, is followed by a high, is followed by a low. You can see that it oscillates. That is the symptom of convergence associated with negative correlation. Then there is positive correlation, where a high is followed by a high and another high and a future high and a future high. There is a directional persistence in the same trajectory, as well as a low is followed by another low, is followed by another low, etc. That is positive serial correlation. There is something amplifying that directional price move in the same direction, as opposed to switching direction, which is what negative serial correlation does. Now, of course, sitting in the middle between negative serial correlation and positive serial correlation is when there is no serial correlation in the data. Now, what that means is that price is independent at all times. So that is effectively dealing with a random series. And when you plot a random series of price, it does neatly fit within a normal distribution, which is no surprise, as a normal distribution is a definition of an independent random price series. So when we are talking about the tail regions, we're talking about looking at this positive serial correlation. And when we're talking about a convergence series, we're looking at the peak of the distribution about an equilibrium, where we're referring to this negative serial correlation. So what the difference between the convergent trader, the gambler, and the divergent trader effectively boils down to the degree, or what form of serial correlation, if it exists, what form does it take? Positive or negative, or is there no serial correlation? So in addition to, a quantitative trader as opposed to a visual trader will be looking at this serial correlation. So this is very interesting to me, because I often do studies where I create random distributions of price series. Now, they're quite easy to create. And what I potentially will do is I will say, here is an existing price series of data. We've got a 30-year price series of data. Now, what I want to do is randomly reshuffle that data to break up any correlation or clusters of correlation that exist in that data. So by randomizing that price series, I can basically make them less correlated. So the price at each interval is more independent to each other. And when I put my trend following models on that price series, lo and behold, they fail. But also I can create from scratch a randomly generated price series where I allow the price series just to stochastically vary in relation to the immediate close of the prior price, how it varies to the next price, how it varies to the next price. I make them independent and I can create a random price series. Now, when I plot with the visual graph of a random price series, visually, I simply cannot tell whether it is a trending price series, a random price series, or whatever. It has all of the features and forms that we normally associate with data that we assume is non-random. Now, what this tells me is that in these efficient markets, this random price series, or the visual form of the random price series, is what tricks so many of us traders into thinking there is something of causative substance or endurance in that price series. But ultimately, it is random. So what I do then is I say, let's take a random price series. Now, what I do is I say, on top of that random price series, let's insert clusters of positive serial correlation in that random price series at discrete intervals across that price series. So what I'm doing there is I'm creating a small bias in the random price series, so that visually it still looks the same as the random price series. The only difference is, taken from the origin, the random price series and the price series with positive serial correlation in it, they diverge away from each other. Now, it's this divergence which is this momentum that we're looking for, which we are targeting with our trend following models. It's not a visual thing, because we cannot tell visually what the difference is between a correlated price series and a random price series. But there is a divergence in the price series itself, which allows for our systematic rules-based process to capitalize on these trending conditions. So it's far less a game of visual identification, and it's more a game of how do we know if we've got this degree of positive serial correlation in that price series. Now, I've talked how I do it, creating these random price series, but really that is another academic exercise, because, when I'm trading the right-hand side of the chart, I'm not going to be able to statistically immediately analyze that prior price series to see if there's correlation in it. But what I am doing is I'm delaying my entry into that trend to wait until we get to this, there is a greater chance of reaching this tail region. Now, one of the reasons that the tail regions are so important is that we know there are clusters of positive serial correlation in tail data. In other words, that is what causes the extreme magnitude of the tails on the left and right tails of the distribution. There is this momentum baked in the price series that is amplifying the price series in this directional way, well beyond what a normal distribution implies. These power laws that reside in these tails is a consequence of these clusters of serial correlation, or this positive serial correlation. So whilst I can't definitively tell whether I'm riding a trend which has this positive serial correlation in it, what I'm doing with my entry signal is delaying my entry until price becomes of sufficient material extent that there is a great chance it doesn't fit neatly within that normal distribution, and there is a greater chance that it lies within those tail regions where we know positive serial correlation exists.
So in other words, this exercise of manipulating the data, which of course you could say on one side, you could say, well, that's completely irrelevant because the data is the data, the actual market data is the data. We can't manipulate that. But what you're saying, if I understand correctly, is that by doing this exercise, it has helped you kind of refine a little bit how you want your models or when you want your models to enter. But once that exercise is done and it's kind of proven, the point you want to use, this is not an exercise you need to do again and again, I imagine.
No.
Yeah.
Yeah, exactly.
Yeah. Because I think this is one thing, Rich, where I think that there was a Twitter comment this week that I commented on. There was someone who wrote something about trend following, that we're over not complicating, but we are overdoing the automation also making, and I didn't quite understand the point of how we're doing that, because yes, we do use math, because if it was so simple, then clearly everyone would be doing it. So we make it sound easy, but it doesn't mean that it's simple. So of course there is some math in it, and what you've just described is some of the math you're using, so to speak, to prove a point that then can help you in designing your algo, so to speak. But I'm also aware that we don't want to overcomplicate. I mean, that there is this fine balance where we definitely don't want to overcomplicate matters too much. But I also think we have to be transparent and say there is a reason why we have, highly educated and experienced researchers like yourself, Rich, and of course people who work for these trend following firms, who spend a lot of time thinking about small tweaks, small details that actually may make a decent enhancement if you can get it right. I mean, I'm sure that 90% of or maybe 95% of the stuff they work on will be dismissed because it just turns out not to be robust enough. But let's leave the topics for today like that. This was great, Rich, as always. And hopefully it's given people something to think about in terms of trends and how they may form, and the fact that there are many ways of looking at it. And also what I really like about the fact, because I've seen some of your data, and that is, of course, you're absolutely right. To the naked eye, you really can't tell the difference whether a time series is random or whether it has a bias. It's very hard to tell the difference. So the devil is definitely in the detail sometimes, and so that I appreciate a lot. And of course, everyone listening to our conversation today, if you love these conversations, then please do go and to Spotify, iTunes, Amazon, wherever you listen to these conversations, and leave a rating and review. That would be great. Which reminds me actually about a rating I got this week. It's rare we get it, but we did get a low rating from someone, I have no idea who it is, who basically said, it's great that you talk about how wonderful trend following is, but can't you just tell us how? And I don't think that the person who left that rating has actually listened carefully, because I do think we spend quite a lot of time, and not least by you, Rich, being very transparent as to how we do this. But this is not a podcast that's going to just give you a cheat sheet and say, oh yeah, this is the 5 things you need to put into to your system, and then you're off to the races. Because if we did that, and some people do that, some people want to make it sound like, oh, you can just get it off the shelf, or you can just get it from the internet, and then you're the trend follower. That's just not how it works in reality. But hopefully these conversations will help people, encourage people to either do it themselves, do the work. This is about doing the work. You can't just rely on other people to do the work. Or, and maybe to the listener who left that rating of just give me the how, well, the how is then go and invest with an experienced manager. That is the how. That's the easiest way you can do, because there are plenty of good funds out there. So that is, of course, one way to solve that, I would say. Anyways, next week, we have a fun conversation, I think, a little bit out of the usual format, because we are going to be joined by Andrew Beer, or I'm going to be joined by Andrew Beer to discuss trend replication, a topic that has come up a few weeks ago. And there's already questions that have come in, but I would like some more to choose from. So do send your questions to info@toptradersunplugged.com. I'll try and have a meaningful conversation with Andrew. Of course, I have my own questions and concerns. But I think it'll be a fun conversation. Andrew is great at explaining these things. So yes, next week will be a little bit different, but hopefully lots of fun as well. From Rich and me, thanks ever so much for listening. We look forward to being back with you next week. And until next time, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.